How is everybody? Creepy quiet. All right, guys, it's 6:30. We're going to be starting shortly. So I am Karla. It's always my pleasure to stand before you to talk about tax. I am a tax girl for sure, right? Tax season is over, thank the Lord. Thanks for, those small things. Tax season is over. It was a unique tax season this year, especially with all the tax law changes and needing to explain that to clients and making sure that they understood what was going on. I think a lot of clients were very surprised with what transpired for them this tax season, especially those clients that did not plan. I think they were shocked at what they ultimately received in terms of their tax bill. Anyway, I thank you guys for joining us. We have our KDA educational event the second Tuesday of every month. And these events are purely to bring you knowledge. I think knowledge is power, and the synergy is always in the room. I may lead the conversation, but I will not say that I know everything there is to know about real estate. I know a lot about tax. There's probably 2% I don't know that I can research and figure out, right? So I'll never say we know everything. I think that it's important to be before people that are like-minded, that want to learn things together. Questions bring about thought, and thought brings about education when you start to have conversations about things. So I'm definitely happy to be with you this evening. Our conversation tonight is how to analyze any real estate deal and know if you're overpaying your taxes. And about 20 minutes are left. I think it's important to learn how to analyze real estate deals. And just as a show of hands, how many of you in here currently own real estate? Okay? And I venture to guess the rest of you are trying to get into real estate, correct? All right, well, very good. So I know for me, when I first started out in real estate, I had a very lightweight understanding of it, and I think it's important as you level up to understand how to look at real estate deals. So before we get into that, I'm going to give you guys a little bit about my background for those of you who may or may not know me. Again, I am Karla. I consider myself a tax strategist. What does that really mean? That means that I believe that we should strategize when it comes to our taxes. I don't believe that we just think about our taxes from January through April. I think that we really need to think about our taxes on an ongoing basis and really plan out what our taxes need to look like. Some of you may not think that that's possible, but that certainly is possible, and I will educate you this evening on what that needs to look like. I am a licensed enrolled agent. I am not a CPA, and I say that proudly. I am licensed in all 50 states, and I hold a license through the U.S. Treasury Department. I have my undergrad degree in accounting, my master's in taxation. I eat and sleep income taxes. I was raised up in a tax law firm where I worked with lawyers who did a lot of tax planning for clients. So that's kind of how I got my yearning to do what I do. I run a full service accounting and tax practice, specializing in reducing tax bills. And that is what we do for our clients. We do tax preparation, accounting, but really people come to us when they just feel like, you know what, I'm over it. I'm sort of over this whole tax thing and I need some help. So that's what we do well. I have a full team and our offices are located just down the street. So let's kind of continue the conversation. So how do you know? Does anybody know if you're overpaying taxes? How would you know that? And this is going to be audience participation. I know some of your names, so get ready. How would you know if you're overpaying taxes? Anybody? Nobody willing to guess if they're overpaying taxes?
If you've never been audited.
If you've never been audited, you think you're overpaying taxes? Wow, that's interesting. I kind of like that a little bit. If you've never been audited, right? They're like, let's not even bother him. He's paying all the money, so we're not even going to audit him. What else do you guys think? Anybody? Does anybody feel like they're overpaying taxes? No? Yes? Let me see a show of hands of who feels like they're overpaying taxes. Okay, a few of you feel like you're overpaying taxes. Why do you feel like that? What is that thing you feel?
Well, it seems like real estate, as what it's come to be, is that you put you in a position to progress financially.
Yes.
However, when you have to pay taxes, you're back to square one to wipe out your savings account or your bank checking account that you built up throughout the year, and you're back to square one. So it's really tough.
Right. So you're overpaying taxes when your bank account is empty.
Pretty much.
That's one way, right? When you write a check to the government, or when you write that check and you feel like, ugh, right? Because I really believe that if you're writing a check and you don't feel like it's a burn in your stomach, then you're probably not overpaying taxes. My goal is to pay $1 million in quarterly estimated taxes. And you may think, oh my God, why would that be your goal, to pay $1 million in quarterly estimated taxes? That's because if I'm paying $1 million in quarterly estimated taxes, you can best believe that my top line is going to be huge. And I'm going to be okay with writing that check. So the whole point is, if you're overpaying taxes, you're going to feel it. You feel like something's not quite right. Your bank account is empty. Other people still feel like they're getting ahead, and you seem like you're behind. You just can't catch up. And it just seems like if you W-2, they're taking a lot out of your paycheck, and it just doesn't seem right to you. If you get that feeling in your stomach, your gut typically does not let you down. You probably are overpaying your taxes. So that is something that I don't want you to second guess. I get a lot of people that will come to me and will say, Karla, how come my previous tax person didn't tell me X, Y, and Z? Or how come I didn't know about this strategy? Or how come I didn't know about that? Well, I will tell you, tax preparation is definitely different from tax planning and really trying to reduce your tax bill. So I want to give you a little bit of education around that. So number one, what are some of the most important numbers on the tax return? I think, to me, the most important numbers on the tax return, people will tell me, my most important number on my tax return is how much money I make, right? How much money you report. How many people believe that's the most important number on their tax return? How much money do you report as income? Anybody believe that? No, that's not the most important number on your tax return. What's the most important number on your tax return? Anybody? How much you keep? Is that reflected on your tax return though? I like where you're going. You're going in the right direction, right? The most important number to me on your tax return is truly how much you're paying in tax. That's the most important number on your tax return to me, how much you're paying in tax. A tax return is not necessarily indicative of how much a person is making. It's really not. A tax return is indicative of how much a person is reporting in income, how much is taxable income, but not necessarily how much wealth a person really accumulates. I have some clients that are pretty well off, pay zero tax and barely report anything on their tax return, and it's all being done legally, right? So the most important number on your tax return is truly how much tax you are paying. That's a very important number for you to look at. Now, certainly I don't want to discount the fact that in some cases, if we are buying property, an important number on our tax return will be how much our adjusted gross income is, depending on what piece of property we're trying to buy. And it also depends on what stage you are in terms of trying to acquire that property, right? So if you're just starting out, you're trying to buy your very first home, you can best believe your adjusted gross income is going to be very important because they're going to qualify you off of that, right? If you're buying your first, investment property and you are 4 units and below, I'm sure your adjusted gross income is going to be important. So I don't want to discount that either. But to me, the most important number on your tax return is how much you're actually paying in tax. But a lot of people kind of get caught up in tax brackets. So do you guys think that your tax brackets matter? Do you guys understand what that means in terms of tax brackets? A little bit, right? Your tax bracket does matter a little bit. So we have 7 tax brackets, and our tax brackets go from 10% to 37%. And basically what that means is that based on how much money you make, there's a certain bracket or a certain category of tax that you're going to pay. This is all good and fancy and all of that, but to me, I don't focus so much on the tax bracket. I'll get clients coming to me saying, Karla, I'm in the 37% tax bracket, or I'm there, I'm here. Okay, that's great, but at the end of the day, I'm more concerned about truly how much money you are going to pay in tax. So I am going to tell you a number that I want you guys to focus on. And the number that I want you guys to start getting focused on, and this is truly an education for you, is your effective tax rate. That's a really important number, and I want you guys to write that down, your effective tax rate. And your effective tax rate really is how much tax you pay as a percentage of your income. How much tax you pay as a percentage of your income. So if somebody is making $100,000 and they're paying $10,000 in total tax, that's 10% of their income, right? In terms of $100,000, they may be in the 37% tax bracket or whatever it may be, but from an effective tax perspective, they're going to be in 10%. And that's the number that we focus on, is trying to get that effective tax rate down as low as possible. At the end of the day, how much are you paying? Yesterday, I was on the phone with a client. This client makes $1.2 million on a W-2. And he was extremely disappointed as how much tax that he is paying on a $1.2 million W-2, right? Can you guys imagine? On $1.2 million, you are having a tremendous amount of state income tax withheld out of your pay, which is not deductible, right? We now can only deduct up to 10 grand of that state income tax. When we did the math on that W-2, his tax that he was paying was over 50%. With all the Social Security, the Medicare, the state tax, the federal tax, it's crazy how much he was paying. So the key is we got to get your effective tax rate down as low as possible. And that is really where we want to put our focus. And that's what I want you guys to kind of think about. So the question becomes, what can you do to really ensure that your taxes are low? What can you do? Do you have any control over your taxes? Does anybody feel like they have any control over it? Nobody has any control in this world? You guys are scaring me. Does anybody feel like they have control over their taxes at all? Is that no? Let me see a show of hands if you feel like you have control over your taxes. Somewhat? Okay, got it. So let's walk down that a little bit. I think that you have more control over your taxes than you think you do. I think you have more control over your taxes than you think you do. And so why do I say that? Because at the end of the day, if you really plan it, you can reduce your tax bill. Did anybody hear about what happened in Amazon in the news recently about their taxes? No? Amazon, you guys are familiar with Amazon, right? Jeff Bezos, he was on the news today talking about he was going to build some type of colonies or homes in the space. I don't know today, it was something. But anyway, Amazon paid, do you know how much they paid in income tax for 2018? Zero. Wow. Wow, right? Why was Amazon able to pay zero in income tax? Deduction. Okay. Losses. What?
What their actual tax rate was?
Yep. They paid zero in income tax. Let me tell you how Amazon was able to do that. They strategically planned to do it. It wasn't by happenstance. Do you think that Amazon was profitable for 2018? Right? I am sure they were profitable. Jeff Bezos was profitable for 2018 because he's going through a divorce. Trust me, he's profitable. Okay? So we know they were profitable for 2018, but they paid zero income tax for 2018. Do you think they did that legally? Right? Okay. So what's the difference, aside from the dollar amount? Okay, we all know that. What's the difference between Amazon and Jeff Bezos and you guys? Corporation. He has attorneys. Accountants. What else? Okay, but you can get attorneys and accountants. Lots of write-offs. What else? Lots of investments. You think he holds some real estate investments? Right? Maybe? Okay. Well, that's really interesting. I am going to tell you the difference. They strategically plan that out. That's truly the bottom line. They are planning on a daily, monthly basis, and I guarantee you they are forecasting out 5, 7, 8 years out. When those tax laws hit, I am certain that those accountants and tax people working in Amazon were all over that tax bill. And they were planning not to pay any income taxes. So it wasn't just, oh, we ended up not paying any income taxes. They knew they weren't going to pay any income taxes a long time ago. They probably knew it as soon as the tax bill started to become champions, right? That's because they strategically planned it. It's not by happenstance that these companies don't pay any income tax. Now, you mentioned that they are corporations, and maybe not. That could be the answer, but the answer truly is they are organized, right? They looked forward. They didn't just wait until December 31st and say, oh, you know what? I'm not going to pay any income tax. That's for sure. You believe that. They've been planning this out, so they got real organized. They also probably looked at their past situation, their past income, and they were able to say, okay, based on what we've done in the past, how can we utilize these new tax laws? And so that's the question that I put before all of you. Based on what you guys have going on currently or in the past, a good review of your 2018, or if you haven't filed 2018, a good review of your 2017 taxes is going to lend itself to putting you in a better position to reduce your taxes going forward. We have to start with where we are right now. So I am certain that Amazon ran models based on their past year's tax returns and ran those models through the new tax laws to see if they were going to reduce their tax bill. You guys follow me? They took the time to stop and do it. They didn't wait just between January and April 15th when their corporate tax return was due. They planned ahead of time. And that is what I'm going to tell you you need to do. You absolutely have to start reviewing your past taxes. The very next thing you got to do is you got to get a handle on your current situation. Good, bad, indifferent, ugly. The client that paid over 50% of his income over the tax, I am certain he wishes he had planned before December 31st closed, right? Now it's too late a lot of times. Once the year end hits, it's very little you can do. It's almost like trying to study for the final the night before the exam, right? You might get a couple of your answers correct, but cramming is not the answer. We need to plan out and we need to forecast. So in your situation, you want to make sure that you're forecasting out where you're going to be for 2019. Taxes can be an ugly topic, but we can make it a better topic if we take the time to plan. Nobody really wants to do it, but I am telling you, the only way, and this gentleman said it best, is that you can build wealth faster when you're not giving all your money over to the government. You can build wealth faster when you're not giving all your money over to the government. And I am not, by any stretch of the imagination, a tax protester, quite the contrary. But I do believe that it behooves you to look at your current situation right now as we close in on 4.5 months. You know, May 31st would be 5 months of the year to project out where we would be by the end of 2019. Whether we like the number, don't like the number, we need to know the number. That's a very important number. And then we continue to sharpen that number up as we continue to go forward in the months. Make sense to you guys?
Yes.
And then once we do that, you want to make sure, however you're going to reduce your taxes, that you have some type of vision, some type of plan for what it is that you're trying to accomplish. As a tax professional, when clients come to me after the fact, like for example, I'm sure I'll get clients coming to me in July and September saying, oh, Karla, I forgot to tell you during tax time that I need to qualify to buy that home. So now we reduce their income down low and they don't qualify to buy that home, right? Because we didn't understand what their vision was. It's so important that you really take the time to think about what it is you're trying to accomplish. You might want to reduce your taxes, and I'm sure you all do, but reduce your taxes and what else are you trying to accomplish? That's really important to understand that. And not just reduce your taxes purely based on, I want to reduce my tax bill. I will give you an example of what I'm talking about. I had a client who she wanted to purchase some real estate. So she runs out and she opens up LLCs in Nevada. Okay, she just goes and does that. And then she decides to purchase all of her real estate here in California. So now she has this Nevada LLC, right, that she has. She owns real estate in California, and then she decided to sell her real estate. Now she has a little bit of a tax nightmare because her LLC does not blanket her in the state of California. She never opened it up in the state of California. It's kind of a whole mess going on right now because she didn't take the time to plan out what she was really trying to accomplish. Planning is so important that you really take the time to plan out your goals and objectives. What do I really want to do? When I grow up, do I want to have 4 doors? Do I want to have 100 doors, 500 doors? Do I want to hold my real estate for long term? What do I want to do? Do I want to donate all of my wealth to charity? Do I want to spend my kids' inheritance? What do you want to do? I think it's important to really think that through because what you do will impact your tax bill. What you do will impact your tax bill. And some things we cannot course correct. So having an understanding of your vision, and it's okay if your vision changes, because things change, right? We need to be fluid. Things are going to change, but making sure that we understand what we're trying to accomplish in the beginning is really important. At least have some type of goal, something to work with. Sort of like bowling. When you go bowling, you put those bumper guards up. We want to bowl. We want the ball to go down the aisle or the bowling alley, but we want to have the bumper guards up so it doesn't go in the gutter, right? So that we at least score something. And I'm a pretty good bowler if anybody wants to challenge me, just so you know. All right, so once we understand the vision, then you can implement the right strategies. There are so many strategies that you can implement to reduce your tax bill, whether it is form a corporation, whether it is buy more real estate, whether it is open up a nonprofit, do a cost segregation study, have multiple corporations, LLCs, S-corps, general partnerships. There are so many things that you can do, but the key is making certain that it's the right strategy for you and not the strategy that you think is for you, or the strategy that your friend did, or the strategy that you Googled, or the strategy right now, and not really think about your long-term goal, right? Like the person who wants to purchase property in their LLCs and they go out and they contract to purchase a piece of property in their LLC, but the lender is not going to lend to their LLC. So now they got a problem. Or the person that goes and tries to do a 1031 exchange and the property that they're selling is under one name and then they want to exchange in the property that's under an LLC and that's not going to be a like-kind exchange because the title is different. So now they have a taxable event and it's a humongous taxable event because they didn't plan out properly. So planning is so important. And once we figure out what the right strategies are, regardless, we got to continue the conversation. Taxes are not a one-time thing. They're not a one-time thing. Compliance is a one-time event, right? Because you have to file your tax return and it's due either April 15th or if you go on extension, it's due October 15th if you're an individual. That's called compliance. Tax planning is all year long. And so my recommendation to you is that you need to have your tax plan together before you put the turkey in the oven at Thanksgiving. You need to have your tax plan together before you put the turkey in the oven at Thanksgiving. Does anybody know why I say that? What was that? You need time to implement strategies, right? Everybody seems to take a hiatus after Thanksgiving. You know, everybody kind of goes into this whole euphoria of the holidays and they're not thinking about taxes. So really, you've got to have that strategy together before Thanksgiving. And the more time and runway that you allow, think of it like a plane taking off, right? The more runway that the plane has, hopefully the plane can get up in the air. The more runway you have, the better your tax situation is going to be. The more time you have to study for an exam, probably the more you're going to learn the information. So just remember that. That is very, very important, that you are able to reduce your tax bill, and we all need to become little mini Amazons until we become big Amazons, right? How many people want to do that? I want to do that, right? That's exactly right. So we need to do some tax planning. As always, we offer complimentary consultations if you guys are interested in that. My team is in the back of the room. They will review your tax return. The cards are on the table if you would like to have that courtesy review done to see if there is a way that we can be of value to you in that area. All right, so now that I told you guys how to read a tax return and what's really important about your taxes, the next thing we're going to talk about is real estate and really how to break down a real estate deal. So again, I am like you guys, I'm an investor. I am not a licensed real estate agent or broker. So I like to bring in experts to own the conversation. I can certainly chime into the conversation based on my experience, but you guys listen to me way too much, right? So it's nice to talk to somebody who's a professional at this type of stuff. So I have with me this evening, and I'm grateful that he came out to speak with us. I have Patrick McCready, and Patrick, he owns the commercial real estate arena. This is what he does as a professional individual. So Patrick, if you would be so kind to come up, and I will be quiet, I'll turn the room over to you, and you can give them an overview of the things that I can't tell them about.
I'll try.
There you go. It's all yours.
All right, thanks, Karla. Just push this.
Yep.
Thanks so much, everyone, for having me out tonight. So this is just going to be hopefully a conversation for you. Feel free to interject, ask any questions you want, ask any clarifications you want. I put a little flyer of the PDF on your desk for your review as well. And just kind of an overview, the points that I'm going to be illuminating tonight, I've put a real life example in that will kind of follow throughout the entire presentation, a deal that I actually did to kind of make it a little bit more interesting with respect to analyzing commercial real estate and what makes a good or bad investment and how to go forth on that basis. So kind of a couple of ground rules. You know, when Karla asked me to put this presentation together, she kind of gave me some parameters that I thought were really insightful and helpful because, you know, intuitively I know some of this information, but I hadn't really, you know, put pen to paper with respect to the do's and don'ts of, you know, purchasing a property. So I took a couple of days to do that, and these are kind of the points that I was able to determine on that. So the first do is to learn the market and develop a clear comprehension of the local dynamics of the market. So, you know, before you can, real estate is, as you well know, all localized. So before you can really make an informed decision with respect to a property purchase, you need to have a clear comprehension of, you know, the local dynamics in the market. Is the market going up? What are the main industries in town? And this incidentally presentation is kind of geared around multifamily purchasing because that's where a lot of the people probably in this room, I imagine, are going to be in as opposed to retail or office or industrial. So looking at the local dynamics of the market is extremely important to kind of determine whether it's a stabilized market or not. Number two, ensure there's sufficient demand for your property and it is actually leasable. So that's a kind of a two-part thing. The one easiest way to look and determine if there's sufficient demand is the vacancy rate in the area. How, you know, quickly do things rent? A lower vacancy rate means that there's more demand for that product. And so when you do lose tenants, which is the absolute key to cash flow and the real Achilles heel is vacancy in a property, you're able to refill that property quickly, but also with really high quality tenants in the area as well. And then the second component of that is pretty self-explanatory, is the property itself leasable. So relative to other properties in the area, if all the properties in the area are 2-bedroom, 2-bath, and you have a 1-bedroom, 1-bath property or 1-bedroom and half-bath property, it's not going to be as desirable. So, on a level playing field in terms of the fit and finish in the property, the amenities that are offered, the actual layout of the property itself, is it leasable relative to the area, and is it marketable? Number 3, complete exhaustive due diligence. I'm a big advocate of this. I don't think you can do too much due diligence, and we'll kind of get into that as well. But the more informed you are, the more confident you're going to be in going in those purchase agreements. You're going to have a clear conception of how much these properties cost. You're going to have a clear conception of how much you can get in terms of rent. You're going to have a clear conception, if you do have vacancy at the property, how quickly you'll be able to fill it so you don't have a lagging cash flow in your particular units. And you're really going to, feel much more confident going into the negotiation and also not overpay for the property, which is really the biggest deal. I always say that you make your money on the buy, not the sell. Number 4, for your first purchase, buy an immediate stable cash flow. Some people may disagree with me on this, but I think that as a first-time or novice investor, buying a piece of property on an appreciation basis is a little bit more sophisticated and certainly more risky. And by appreciation, I mean what you project in the next 3, 10, 12 years that a property is going to sell for at the close of the property. Well, there's all sorts of different market dynamics that come into place, the economy, how well the area is done in total. And if you do not have the capital reserves in order to, withstand your mortgage payments if the property does go down in value or if you do lose a tenant long term, it's not going to be a pleasant experience for you. So if you're buying a property on stabilized cash flow, you're going to be in a much better position, with a stabilized asset. Number 5, ensure you are responsibly leveraged with sufficient capital reserves. Things happen. I can speak from experience. I'm a multifamily property owner myself, and all sorts of unforeseen circumstances come up. So by responsibly leveraged, I mean don't over leverage yourself. So when you're going into a property, make sure that whatever your mortgage payment is, if the property goes vacant for a month or 2, you can cover it. Make sure you've got, if your property's 5 or 10 units, you have $20,000 or $30,000 in the bank. So if someone tears up the place, you can go in and put new carpet and get it back on track. 6, avoid fads, bandwagons, and trends. Buy what is sensible for you. People see get-rich-quick things on TV all the time. I like Chip and Joanna Gaines. I don't know if you've ever seen that show. They're great. They're multimillionaires and they're backed by whatever program they are. And I don't know how much money they make on any of these deals, but I'm not those people. I think you really just need to buy what makes sense for you and avoid the get-rich-quick schemes. Flipping houses is all well and good, but it's extremely difficult and it's very kind of risk intensive. And then hire a local real estate professional. Make sure you hire someone that you trust, that you know, and that cares about you and has your best interests at heart. Okay, so this was a deal that I did, and this is kind of going back and touches upon a number of the points. This is a checklist that I actually made for a client, and you've got it in your packet as well. And this is kind of like an overall demographics checklist to see if you're comfortable or not with the area. And I've actually included websites that you can go to. You can more or less find most information you need. I am telling you right now, I deal with a lot of clients. If you do 85 or 90% of what's in this basic packet, you are doing much more due diligence than half the people out there. Is the area's population expanding or declining? This property was in Bakersfield. It's, in Central County. It's in Kern County. It's the seat of the county. It's a big town. It's kind of, a farming community. It's got about 500,000 people in it with a lot of kind of satellite communities around it. So it's like a B or B plus area, but it's a decent place to invest. What are the crime rates in town? What's the median income level? demographics and population. How close are the nearest elementary, middle, and high schools? Again, this presentation is kind of geared towards multifamily, but those are important because a lot of the people that are going to be in your properties, they're going to have kids. So, is there an elementary school by? Is it a bad elementary school? Is it a great elementary school? And that's going to have, a direct impact on the rents you're able to achieve. How close are nearest grocery stores, liquor stores? It's a big thing for people. Restaurants, churches, movie theaters, gyms. You're really trying to develop kind of an ecosystem of what is the quality of life for these people going to be. And there's a big difference between, a couple of miles if, especially you're kind of in a marginal to low rate area, if you've got a place that has a grocery store, down the street and the other property you're looking at, the grocery store is 3.5 miles away, it's not going to rent for as much, almost guaranteed. Laundry facilities, if they're not in the units, where are they? How close are they if not on site? Nearest freeways and major arterials, huge deal. How quickly can people get to work? And then this, really easy to figure out. A lot of people don't do it. What are the per square foot asking prices for comparable properties sold in the area? How much are things selling for? Are you overpaying? Are you getting a good deal? You can figure that out on a per square foot basis just by dividing the purchase price per square foot or the total square footage, or you can just look at overall. This was for a fourplex, so I looked at fourplexes. This was 6904 Klamath, so I looked at 6900 across the street. What did it sell for? 67.2. You're able to find this information pretty easily, and these all sold in approximately the same time within a year or so of each other. What was this property last sold for? You can go to Land Vision and literally find, in a title report what the property date was. So you can figure out if some guy has been owned this property for 20 years, even if he sells it for slightly less than what market is, he may still be making a couple $100,000 off it. So his impetus to sell is a lot more. Vice versa, if someone bought the property in 2004 and they're selling in 2007, they may have taken a huge haircut on it because of the recession. So those are all going to be driving factors. So try to figure out, the person you're buying from. You can infer a lot based on what they paid for the property and how much debt they have on the property in terms of what their pain points are and how they're going to negotiate. What are asking rents for comparable properties in the area? That's obviously extremely important. You can go to PadMapper, Craigslist, all these different sites and figure out very clearly what you're going to be able to rent your property for. And then vacancy rates in the area. Actually, one of the greatest sites when I was going through my graduate program, and they kind of drilled this into us, was literally going to the census. Go to the government census site, and those are some of the most accurate data points you're going to find in a community. And then is the city rent control. That's the last one. All right, so this is kind of a quick and dirty rule on how to analyze cash flows on a property. People can get into internal rates of return, discounted cash flows, and so forth, but for most of the investors just coming into it, capitalization rates are kind of the standard litmus test for quality of a property. So capitalization rate is just the estimated percentage rate of return a property will make on the value or the purchase price. So it's net operating income divided by value gives you your capitalization rate or your return. And it's just like a bond or anything else, Capitalization rates vary dramatically between different communities. You can have anywhere from 2.5. I see a lot. I work in Newport Beach. Some properties are 2.5 or 3%, but they appreciate like crazy. Up to 7 or 8% in less desirable areas because the risk is higher. So capitalization rates can be determined by two ways: divide the net operating income by the purchase price, and that gives you your rate, or dividing the net operating income by prevailing market rates. So, you can pretty much figure out the capitalization rate one of those two ways. If you know prevailing market rates in a community, all you have to do is look at an offering memorandum on any property you're looking for and divide that net operating income by what you feel are the prevailing market rates, and you can figure out the purchase price in the property. If you know what the rates are, you have a really clear understanding of how much you should realistically be paying for that property per the market. Yeah.
What is a good cap rate? So we hear that cap rate thing all the time. So is it a certain percentage of the cap rate? Is it a certain percentage by area?
That's a great question, and the question is there is no good cap rate. It's entirely based on the area. So, like kind of alluding to my previous example, Newport Beach, it's a very low, to get a 4% cap rate on multifamily there would be considered fairly healthy because the market is extremely strong and you have a high appreciation. So to answer your question, I guess more specifically, you have to look at what the overall market cap rates are for a sub-market. So if in Newport Beach, just kind of keep with that example, the average market cap rate is 3%, if on your property, for a comparable property, you're getting a cap rate of 4%, then that would be considered a good cap rate because you're beating the market. So it's all specifically based on, what the market is in your submarket. Like I said, the biggest rule in real estate is it's all localized. So you really have to have a clear comprehension of your individual market, and then you can figure out. And then it's just a matter of risk tolerance too. But to answer your question, it's just whatever, if your cap rate is exceeding the cap rate for the local market for comparable properties. Similar to a bond, there is generally an inverse relationship between cap rates and risk. Just like a bond, the crappier the bond, the higher the return, the higher yield you're going to get on it. Crappier the piece of real estate, the higher return on it because the risk is so much greater. Now that's not always the case. You can have uninformed sellers who sell at below market, and that happens sometimes. Most people who own commercial real estate are relatively sophisticated. And they have it fair because they get hit up by people like me all the time telling what their values on the property are to try to get a listing, right? So they're probably going to have a pretty clear understanding. But as a general rule, if you're paying, if the cap rate is higher, that means the risk is greater, and if the cap rate is lower, that means the risk is lower, and your price per square foot or per pound go up. So let's go back to so this is the next slide, and this is how you basically figure out cash flows, because I know this is important. This goes back to the original due diligence. So I kind of like to go in a logical sequence whenever I'm analyzing a deal, because just like you, I don't want to waste time. So the very first thing I do is I do the demographic study and see if the market itself is sufficient and if it's a solid enough market to even invest in. So you've gotten past check one. You've invested enough time to learn about the market in general and are comfortable enough to say, okay, this is a place where I want to plant a flag. This is a place where I want to initially invest. Then, second step is you actually go out and find a piece of property. Now, you get into the nitty-gritty of doing your due diligence and figuring out what your actual cash flow analysis is on a piece of property. Now, as a broker, I can tell you, this may be an open secret or not, but offering memorandums are not always the truth. OMs keep brokers lie. That's just the truth. Or numbers are embellished sometimes. You need to be in a position where you can confidently determine or ascertain by yourself what you think the cash flow on the property is going to be. So for this particular deal, I literally put a spreadsheet together and figured out, and I do a fairly conservative metric on everything, what I thought this property is going to be. So this is the actual spreadsheet, and we just finished the first year pro forma. We were a couple $1,000s off, but we did a pretty good job of guesstimating, what this property was going to produce. So let's just go through it real quick. You got your potential gross income. That's the income you think the property is going to make every month if every unit is rented in full at market rates or slightly above market rates. Then you have your vacancy. I have my vacancy always pegged at 7.5%. A lot of pro formas will have it pegged at 4.5% because obviously it's going to boost the net operating income. So I use a more conservative figure. So I say 7.5% out of the year, there's going to be vacancy at the property. Potential gross income, less vacancy gives you your effective gross income. Effective gross income, less operating expenses gives you your net operating income. Rock solid rule, net operating income is always above debt service. Net operating income is always above the line, debt service is always below that. Because the property assumption values are always based on your net operating income before debt service and before depreciation. So depreciation, debt service always below line items. So operating expenses, management fees. This particular client doesn't want to be a manager on the property. I wouldn't either. Dealing with tenant problems is tough and irritating. So their management fee for 4 doors was $200 a month, $50 a door, pretty standard. So we put that in because he knew he didn't want to manage the property, so that reduced his income, which is fine because he wasn't up there. PG&E is gas. Everything is submaster metered on most properties. Trash, you just pay for the big dumpsters outside. You usually have something like this, and depending on the property, you may have like 2 of them. Water is just water you almost always pay for. Water is pretty cheap in Bakersfield, but water is almost never paid for by the tenant. Tenant pays for data, so satellite and internet. Tenant pays for electricity, and tenant pays for gas if they have it. Supplies, they just put that in at $240 a month, paper, postage, whatever. Advertising, legal miscellaneous. This particular management company said, hey, we're going to put a couple ads on Craigslist, but we're also going to put ads on PadMapper and things like that, and it costs a little bit for internet advertising. Repairs and maintenance. That ended up being way low. It was about $4,000 or $5,000 because one tenant, who was a lovely lady, been there for 20 years, but she moved out because she bought a house and the place was a mess. They had to redo the carpet, they had to clean it up, and there was a lot of extra work that had to be put into it. One thing I would say with respect to repairs and maintenance, if you are a first-time purchaser of multifamily commercial property, I would strongly encourage you to purchase a home warranty. And they run about, for this particular property, it's about $1,700 a year. And what it covers is the building systems for the property. So what they will do for $75 a pop, they'll go out there and fix anything that's wrong with the property, and if they can't fix it, it's covered in your replacement. A good example for this one of the chillers on the units, or the AC systems, was about $5,000. They went out and fixed it twice. It was $150 to them, and then the entire thing went out. It was paid for by the homeowners, or the home warranty. So it's kind of like a mini insurance plan. And it's something that not everyone goes for because maybe they have good contractors or friends that they can get deals on. But I always encourage people to do it because it's just like an extra safety net, so it doesn't blow you out. Landscaping, that's just, gardening, they have a little lawn in the front. Pest service, that's just for termite reduction. The home warranty we put in there, it was $1,400 for the year. It ended up being more like $1,700. And then your property taxes. And in your escrow statement, they will have your estimated property taxes, so you'll be able to figure that out. Total operating expenses was about $18,000 a year. Net operating income, those are total operating expenses. Net operating income was about $20,000 a year. This particular client was putting in debt service on the property, and then we put that in. So it was before tax cash flow was $456. So, he had to have some capital reserves on it, but it was paying down the equity, and he got most of his cash out of the deal when he was done. So, going back to the capitalization rate example, using this fourplex in Bakersfield, if you divide the net operating income, which we determined, I just rounded it for ease, I think it was like $20,480, so I just rounded it to $20,000. I know the purchase price here is $400,000. He had a 5% return on this property. Solid, base hit. Not spectacular, but a good thing for his kids. It's a 30-year fixed amortization at 4.5% because rates are low right now. In 30 years, it's going to pay down the debt. He'll be able to pass it on to his children. That's exactly what he wants to do. He wants to have 5 or 6 of these, each making $20,000 a piece. By the time he's retired and his kids are in their mid-20s, he'll have something to pass on to them that'll have a cash flow of $150,000, $200,000, and it'll be all paid off. So, if you get 6 times 4, that's $2.4 million.
I don't see this $20,000 cash flow. I see $456 a year.
Yeah, that's after your debt service. So that's why you have to have cash on the side. Yeah, so he put a lot of debt on this property so he could get his cash back out of it. The net operating income is based on a full purchase price. If you recall, debt service is always below net operating income. So if he was to buy, but to your example too, if he was to pay $400,000 in cash, he would put $20,000 in his pocket yearly, which isn't bad. It's a 5% return. It's not great, but it's not bad. Dividing an operating income by the market rate is $400,000. Similar to a bond, there is an inverse relationship between cap rates and risk. And if you would purchase that property at a 6 cap, you can see it goes down by $333,000, which is a reduction in purchase price of about $66,000. Now, one other thing I will mention that is a kind of a benefit that happened here. This property went up in value by about $150,000. So even if you don't think that 20 grand is very good for a cap rate, which is like okay, he made $150,000 in 2 years just in equity on it. 3 good deal indicators. These are the last kind of notes I'll leave you with. Physical condition of the property is one good deal indicator, how well the property's been maintained. Long-term leasing history, so that's kind of indicative of how stabilized the property is. Sub-market performance over time, how strong is the market. And the last tips and takeaways are stay away from fixer-uppers or capital-intensive projects unless you're experienced. Don't overextend yourself financially. Seek advice from lenders, financial advisors, and accountants and brokers. And take pride in the property. And the last thing I always like to leave with is remember that tenants are really your best assets and stakeholders in your property. If you're able to foster a good relationship with the tenants in your space, they'll tell you about problems instead of just avoiding them. So if you have a leaky pipe or something like that, it'll actually get fixed quickly and not cause a $10,000 problem instead of a $50 problem. And they'll be loyal to you if you're loyal to them. The worst of the bubonic plague of any property, regardless of class, of industrial, retail, or anything else, is vacancy. Vacancy kills value, it kills cash flow, and anything you can do to avoid vacancy is what makes the asset work. That's it.
So, does anybody have any questions for Patrick before I ask him some questions? Yes.
Quick question regarding your spreadsheet.
Sure.
Do you have, is this something that, I have one that I use, but is there something that you access or do the program or whatever?
I just made that up. But I can email it to Karla and she can give it to you. I don't care.
Okay, and then I have another question about the prevailing cap rate. How do you determine that, the prevailing market cap rate?
How you determine the prevailing market cap rate is what other assets are selling for in the area. So, if you've got a couple of different, say you're looking at 3 or 4 different buildings and looking at the OMs on those buildings, you can figure out within your market, with even in your sub-market, so in your neighborhood, what buildings are selling for. That the simplest way is recent sales, right? So doing comps, but then also what things are actually selling for right now. So, if you collect 3 or 4 OMs or listings from a couple of different brokers, you can figure that out. And that's the best way. And then just ask brokers questions. Don't ever be bashful about asking questions, even if they seem annoying.
Was there another question? Yes.
I was intrigued by your mentioning about the home warranty.
Yeah.
I've never heard of home warranties for apartment multifamily.
Mm-hmm. Yep.
Is that available for large complexes as well?
Yeah, they are, and they kind of act as insurance policies, to protect the building systems. And your big ticket items are always going to be your roof and your HVAC for most things, plumbing obviously as well. But the one thing that really scares me, especially in warmer climates, like if you're buying in Los Angeles or California really in general, is the HVAC system. It's extremely costly to repair, and they do have a useful life, and useful life is anywhere between 15 and 20 years. But by year 18 or 19, they're really starting to give out. They're being used fairly regularly. So yeah, it's just one other way to kind of protect your cash flow for the year.
Do we have other questions? Okay, so I just have a couple questions for you. On the performer where you did the spreadsheet on the numbers and you got like the utilities and things like that. Yeah. So are you able to go to the seller and actually ask for copies of the utility bills? Oh yeah. There's more like comprehensive due diligence packets when I'm actually working with clients. That's a great question. Yeah, it's what's called commonly as historicals. So firstly, if they're worth their salt at all, they have a halfway decent accountant and a halfway decent property manager doing not pro formas but P&Ls for the past years. The P&Ls, can be inflated, right? Because people cook the books sometimes. It's just part of it to try to get a higher purchase price or justify net operating income. But you should always ask for historicals. So historical operating expenses, and those are going to be utility bills, and they should have those, right? Because if they have a property managing or if they're doing it themselves, they got to be paying that stuff. So ask for at least 3 years of that so you can get a balanced average. And
if they've asked to own the property for 3 years, ask for 3 years of profit and loss statements, or better yet, ask for 3 years of tax returns. There's nothing, when you negotiate too, you can ask for whatever you want. The only answer you're going to get is yes or no. So the more information you have, the better armed you're going to be to have an accurate pro forma and know what the property is really producing that. Because people get blindsided all the time. So yeah. So and if the other broker isn't willing to perform on those things, then that's generally a really good indicator of the writing something.
Right. Because when you're going to go get a loan on these properties, then the lender is going to be looking at those operating expenses. They want at least 2 years history on those operating expenses, right?
No, not always. That's the trick. Is a lot of lenders are only looking at what the market rates are in the area and what they think the property can get. It's just a debt service ratio. They've got a standard ratio they put in. It's usually 45 to 50%. But other than that, if you can't make the payments, you can't make the payments.
Gotcha.
So they just use there's on a spreadsheet in New York putting these things in and saying go or don't go, and that's it. And they don't care because the loan just gets bundled and sold to the secondary market, just like the whole housing prices. So they don't even hold it on their books.
Mm-hmm.
So no, they don't really care.
Do you guys have any other questions?
I'm just trying to be candid.
Yeah, no, I got it. All right, I am going to take it back over. Thank you so much, Patrick. Really appreciate it. So, very, very informative. So a couple of things that I really want to point out that Patrick covered, but I really want to reiterate is really doing your due diligence, right? So what is your personal preference when you are purchasing property? What is your rule of thumb? And making sure that it's something that you as an individual can digest. So when Patrick gave you guys the due diligence checklist, and he listed on that checklist, I want to say there were 12 things that he listed on a checklist. I think that when you are purchasing property, there are certain things that you need to look for. So one of the things that I like to look for when I purchase property, I like property in areas that families are going to live, that are near schools. I just have this, and maybe because I have a family, but in my gut, I kind of feel like when you purchase properties in an area, especially like multifamily, where you purchasing, I usually do 2 units or more, and I usually like it to be located close to a school. So my thought has always been in purchasing property that I want to kind of get tenants that can live in a nice area, but maybe not really in a position to kind of buy their own home. That's always kind of been my mindset, right, wrong, and different. It has kind of worked for me. And I have a tendency to stay away from areas that I personally wouldn't feel comfortable going to go collect my own rent. Not to say that the cash is not green, but that's just sort of my own barometer. People have different things that they look at. I have a client that owns a bunch of property in the inner city of LA. I mean, her cash flow is incredible. I personally wouldn't buy there, but she buys there. So you got to kind of figure out within your own self what's important to you, right? Because at the end of the day, this is property that we're going to have to deal with. In regards to having reserves, and Patrick mentioned that as well, to make sure you guys have proper reserves, some of the craziest things happen. So I am going to tell you, I have been in this whole real estate market when I've been in the market for a long time. So I'm not going to tell you guys my age, but I've been in this real estate market for a very long time. I've been in a couple of cycles of the real estate. So when the real estate market was really hot and everybody was purchasing property and then the real estate market dropped, people started losing properties. I think that real estate, of course, goes up and down, but I think people are going to always, for the most part, pay their rents, right? People need a place to live. So what was that thing that caused a lot of people to really lose their properties? And I think it was not really planning for vacancies or getting into loans that they couldn't really afford. So what is your money rule? And I like to call them money rules. What is your money rule for how many months worth of a mortgage that you feel like you can pay? Because at some point, if we are aggregating a lot of real estate, and let's say we go from one piece of property, 10 pieces of property to 50 pieces of property, could we really out of our pocket debt service all of those notes if we had to? So you got to figure out what's your money rule. How much of your mortgage could you debt service on a monthly basis? Like, what does that need to look like for you? When I first started out buying property, I used to say to myself, okay, I need to be able to pay that note if everything goes to hell in a handbasket. I got to be able to pay the note. But as you start to aggregate more properties, you're not going to be able to pay those notes. So are you going to be able to pay 25% of it? 30% of it is something for you to think about. I've seen clients have major catastrophes and lose property because they're running their margins too thin. I think that when you go out and you start to buy these properties, you got to come up with what your own money rules are. And then you also have to think in terms of, once I'm starting to amass my cash flow, when am I going to start replacing things on my property and putting my money back into my property? Because at some point, you can't let the property become dilapidated, right? Because eventually that's going to catch up to you. And then you're going to be out of pocket a lot of money. I have a client right now that has a 8-unit building. They just had a pipe burst at the building, and that is having to be replaced out of pocket. They had a situation happen with the staircase on the building. That was a $30,000 fix, and then it got vandalized, and the contractor didn't have insurance to cover it. So these types of things happen when you're dealing with property. So you really got to think to yourself, how much am I willing to put at risk, and how much do I have to pay for it? I love your comment, Patrick, about getting these warranties put on your property. Try your best to insure against risk, right? Because it's going to happen. I mean, eventually something is going to transpire, and you're going to have to pay out of pocket. I remember on one of my rental properties where the tenant moved out, and when they moved out, they decided to go inside the property and take the cabinets and all the appliances and everything. I mean, they practically pulled the carpet up off the floor, right? Who does that? Tenants sometimes do that. So you have to be prepared to look at those things. So I guess our most important takeaways this evening are knowing how to do your due diligence. Hurry up and go slow. That's what really I hear. Hurry up and go slow. There's going to be another deal tomorrow. It's not the last deal. I think sometimes we get anxious and we feel like, oh my God, I got to put an offer. There's not going to be another deal. There's going to be another deal. So you need to hurry up and do your due diligence slow and really take your time to analyze it and get the right people on your team who understand how to run numbers, who understand how to calculate percentages, use professionals. And I don't know, for me personally, something else that I never do, and this is good, bad, and different, but I never go with the listing agent. If I'm going to get a property, I'm not going to go with the agent that's listing the property. Now, some people may have a difference of opinion, but personally, I want somebody to represent me and me only. Like, I feel like whomever they're getting paid by, that's who they're going to have their allegiance to, right? You guys follow what I mean by that? So if we have a piece of property that's listed and you happen to walk up on the property or get in touch with the agent, right? And if that agent is representing the seller, he can't represent me too. That's just my own personal preference. I'm not going to do that. So, do you guys have any questions at this point? No? Did you guys find value in the conversation? Right? So, what are our takeaways? Get a spreadsheet. Patrick said he would email me that spreadsheet, and so if I have your guys' contact information, I will email it to you guys. Get a spreadsheet, make sure you do that. Come up with your money rules on what is comfortable for you in terms of purchasing your real estate. Think it through, and just go out there and make money. Become a mini Amazon, right? That's the end goal for everybody. Again, if you guys have questions or would like to have a consultation or even have a consultation with Patrick, fill out your card. I'll see to it that he gets your information. I think it's important to align yourself with professional people who do this on a daily basis. You know, when the real estate market got hot, we got all these fly-by-night realtors, right? Everybody became a realtor overnight. I just believe in professional people. I want to work with people. This is what they do. This is what they eat and sleep on a daily basis. Like, I don't want a surgeon that today he's doing surgery and tomorrow he's a lawyer, right? So we definitely want to work with professionals, that's for sure. All right, guys, we try to keep this to no more than an hour. We're coming on the hour. So unless you guys have any questions for me, anybody? All right, well, I am Karla Dennis. It is always my pleasure to talk to anybody that wants to talk about tax and real estate, right? Thank you guys so much.